Okay. Okay, so good evening, everyone. Thank you for joining today's CFD webinar. What's next for US equities amidst geopolitical tension? So we are honored that we had invited our regional head of retail research, Billy, and then our market strategist, Wayron, and also our dealer representative, Yuhana. Okay, so I'm Sing Hui. I'm going to guide you the introduction of CFD. Okay, so disclaimer first. So this is our disclaimer. So throughout the webinar, we are not giving any trading, buying, or selling call. So this webinar is strictly for educational purpose only. So these are the content that I'm going to cover later on. Now, what is CFD? So CFD stands for contract for difference. So this is the contract that made between the buyer and seller to gain exposure to an underlying asset without having to take the ownership of the underlying instrument, whereby the difference between the opening and closing price are cash settled. So these are the type of CFD that we do offer. So which is share CFD, REIT CFD, and also ETF CFD. And then as you can see from the table, so if you are trading like AAPL CFD, so the underlying is actually a per share. And then like if you are trading IGB REITs or maybe Pavilion REITs, it will be same as the underlying, just that you don't hold the ownership of the underlying instrument. Now, for your information, for the CFD that to be offered by us, there are some certain criteria that need to be fulfilled. So first, for Bursa CFD, first, it must be listed on member of Bursa Securities. And then the underlying corporation must meet the 3 months average daily market cap of 500 million for the past 3 months. So if it's a newly listed corporation that does not meet the 3-month market cap track record, then it must have 3 billion of market cap. And then the underlying corporation must meet the public shareholding spread requirement at the date of offer. So here are the FC website link of the guideline of how we can offer the CFD. And then one of the beauty that you are trading CFD with us is that we are using a direct market access model. So means that the order that you send to us is directly where we send to exchange. So we can assure that you get the real time and true market price. So unlike like market maker model, the order are actually going to the CFD provider and then they hedge against your position. And they might mark up the bid and ask spread. So these are the benefit of trading CFD. Let me explain them in details. So first, you will get leverage. So for example, if you want to trade like CIMB group, 1,000 unit at 7 ringgit 50 cent. So with CFD, because of 10% margin that we offer, you only need to come up with 750 ringgit only. However, if you are trading like traditional share, you need to come up with 7,500. So same like Nvidia. So if you are trading like 100 units at $200, with CFD, 10% margin, you come with 2,000 only. But if you are trading with traditional share, you need to come with 20K dollar, which is like capital intensive for some of you lah. So with margin, you will only need to come up with small capital to gain less exposure to the underlying instrument. Like 20% margin will provide you 5 times leverage, and then 10% margin will grant you 10 times leverage. So with leverage, the gain and losses are magnified, and then the risks are also much greater lah. So there will be no maximum gain on your trading position if the market is moved in your favor. However, if the market is moved against you, then you may lose more than the fund that you deposited in. But one good thing is that your risk can be mitigated or minimized by using our trading platform comprehensive suite of contingency orders. Now, the second benefit is that you got the flexibility to long and short. So, like if you are taking a bearish stance, then you can sell the CFD first and then you buy back later. Now, the third is that there is no expiry date of contract if you are trading CFD. So, as long as you have sufficient fund to fulfill the margin requirement, you can hold the CFD how long it depends on you lah. So unlike like futures, they have their own expiry date. So the fourth is transparent pricing. Like I mentioned just now, because of we are using DMA model, so you can participate in the liquidity and order book of the underlying. So you can be assured that what you see in the CFD trading platform, the price, then you can get it. It will be same as what you see in the share trading account. Now, the fifth is you can participate in corporate action. So despite you are not actually owning the underlying instrument, but you are still can entitle the corporate action like cash dividend, bonus issue, share split, and also consolidation. Now, for example, if you are holding 10,000 units of Apple share, and then they announce 27 cents or dividend, now you actually entitled to this $2,700 of dividend, but before withholding tax lah. But to keep in mind that CFD is not entitled for any voting rights. Now, if you are trading CFD with us, all the CFD will be settled in their respective settlement currency. So all the profit, losses, or charges that arise from the trades held in your account is in the respective currency. So they will not be automatically converted to your preferred-based currency. So you can always instruct us that you want to convert, and then we will perform for you. Now, how much are the fee if you are trading CFD? So first, we have commission fee. So commission is charged as a percentage of full contract value of the underlying stock that you are bought or sold. So here's the formula of commission, which is trade quantity times trade average price times the commission rate. So for example, if you are trading XYZ company, 5,000 unit at 10 ringgit, and then commission fee is 0.35%, then you will get charged 175 ringgit. But if you are trading slightly lower contract value like ABC counter 10,000 units at 5 ringgit, but you will get even the computation will be slightly lower, maybe around 20 ringgit, but then you still get charged of this minimum commission of 40 ringgit lah. So you can go to our website to have a look on our latest commission rate. And then the second fee that we impose is overnight financing fee. So this overnight financing fee will be charged if you are holding your position overnight. So meaning to say that if you close your position on the same day, then there will be no financing charges. So this financing charges is computed based on end of day mark to market value of your CFD portfolio, and then will be charged on full contract value. So how do we calculate this overnight financing effective rate? It will be taking financing rate plus or minus the central bank rate. So it's depending on what's the direction that you are holding. And then the accrued days will be Monday, Tuesday, Thursday, 1 day each. But Friday will be counted as 3 days because in consideration of Saturday and Sunday. And then the number of days in years will be 360 days for USD sector CFD, and then the rest will be 365 days. So same thing that we have posted our financing rate on our website as well. Now let's go through the example of the long financing and short financing. How do we calculate? So for example, if you are holding long position, 1,000 unit at XYZ CFD, mark to market price is 10, and then from day 1 to day 2. So the effective rate will be summed up from the financing rate plus the central bank rate, so equal to 6.73% per annum. And then because you're holding 1 day, so the end is 1, and US position, so year count will be 360. So long overnight financing fee will be the contract value 1,000 times 10 times the effective rate 6.73% divided by 360 days. So you will get charged $1.87 if you are holding 1 day lah. However, if you look at the short financing with same scenario, you will see that the effective rate is actually lower because you are using financing rate deduct by the central bank rate. So you will get charged only 0.77% per annum. So you see the short overnight financing fee, in the end, you get charged only $0.21. So in the case that the central bank rate is greater than the financing rate, then this short overnight financing fee is actually credited into your account. So you might be weird that, why I can receive financing fee? Now, how you can potentially profit from CFD? Let's go through this profit scenario. So on Friday, you buy 100 units of Microsoft at $400. So as you can see, we have comparison between traditional share and listed share CFD. So you see on the initial outlay, for traditional share, you need to pay the full payment, so which is 40K. But for share CFD, because of 10% margin only, so you only need to count with $4,000. And then same thing that you will get charged commission, assume that both are the same 0.2%, so you get charged $80. And then on Wednesday, you exit the position with profit. So you exit on 420. So you actually, your profit is $2,000 for both. And then commission fee, something that you will get charged 84 for your exit trade. And then for financing cost, because traditional share don't charge any, but yeah, we do have charge financing fee, so you get charged around $38. Now, when you calculate the net profit, so we get 2,000 profit, deduct the entry and exit commission fee. So for traditional share, you will be your net profit will be 1,836 ringgit. But for CFD, you deduct another financing cost, so it's around 1,797. Now, when you look at the return on initial outlay, traditional share only grants you 4.5%. But for listed share CFD, you will get 44%. This is because for CFD, you only count with 4,000, the initial outlay. So it grants you so much of the return. So these gains are amplified due to the leverage. Well, if you are looking at the loss scenario, same thing for the entry, but for exit, you are exit with $380. Now you see that the same thing losses, you get losses 2K. And then for financing fee, yeah, both are same. And when you look at the net profit, net losses, traditional share is 2,156, and then share CFD will be much higher because including the financing cost lah. Now, when you look at the return on initial outlay, traditional share make you lose 5% only, but for CFD, it make you lose around 54%. Yeah, this is also because the losses are amplified due to leverage. So the risk of loss in CFD trading can be substantial, and you may lose more than the fund that you initially put in. Now, here are the risks that associate with CFD, included but not limited to like leverage risk, counterparty risk, market risk, liquidity risk, and so on. So until you fully understand the product, benefit, and also the risks associated, you should not trade CFD. Now, if you are considering whether the CFD trading is appropriate for you, then you should ask yourself, do you have previous investment or trading experience in financing products such as securities and derivatives? Do you understand the difference between investing in shares and trading in CFD? And then do you understand the concept of leverage, margin, and volatility? Are you prepared to monitor and manage the risk of trading? And can you afford to lose all of or more than the initial capital that you put in? So if all the answer are yes, then yeah, CFD might be appropriate for you. So how you can trade CFD? We will providing you an online CFD platform. So the selected market data feed are delayed by default, but you can choose to subscribe it and subscribe the real-time data. And we are currently absorbing the real-time market data feed. So these are the platform features that we have, like view your account summary and portfolio, and then create your own watch list, input the order, and also search and view your historical order and executed trades. Now, here are the order types that we do have in our trading platform. So including market order, limit order, stop loss order, and also take profit order. So this is how the platform look like. We do have our web-based and mobile-based trading platform available. And if you would want to know more about our CFD, we have prepared our CFD Investing 101 video series on our corporate website. So you can go through it and if you want to know more. Now, we are launching our CFD campaign 2026. So the campaign period is from 1st of April until 31st of December 2026. So you will stand a chance to win like Microsoft, Grab, or Chow Tai Fook CFD. This depends on like if you start trading, then you will be automatically enrolled to this campaign. So the more earlier that you start, the higher chance that you can win the higher price. Okay, so if you want to trade CFD, you can contact your reminder or futures commission broker. So if you don't have one, feel free to contact us through the contact detail that I share here. However, do note that CFD can only be traded by sophisticated investor only. Okay, so if you are not, then don't be upset because our dealer representative, Yuhana, will be share about the margin financing. Okay, so here's my part, and Yuhana, I will pass the floor to you.
Hi, thank you, Zoe. Okay, I present first, yeah?
Yeah.
So, the slide, okay?
Yep, can see.
Okay, good. So, afternoon, everyone. Today, I will share how you can boost your investment potential using share margin financing. This is just very short for everyone who are interested in leveraging their shares. Okay, so we call it SMF. We will cover what SMF, how it's work, its benefits, and also how to manage the risk. So, introduction to the share margin. So, boost your investment potential with margin is actually SMS stand for share margin financing. It allows investors to buy more share than their available cash using leverage. There are two types of margin, which is the first conventional, the second is Islamic. So both of the margin is actually for Bursa Malaysia stock. We are focusing on Bursa Malaysia stock only. So for target audience is basic investor who are excited or who want to explore more about leveraging the shares. Okay. So let's start with understanding share margin financing. What is the share margin financing? Is SMF allow investor to buy shares beyond the actual cash deposit by borrowing fund, increasing investment exposure. So some of them can put collateral and as a financing. So type of account, as I mentioned, there are two types, Islamic and also conventional. And then risk and reward. Whoever interested in a margin normally they trade because of the high potential in a short term or in a long term. That's why they are using the margin. So for the key advantage for investor, so SMF allow investor to trade up to 2.8 times, meaning you put cash deposit, you can leverage more at the market without fully put upfront cash. For settlement is a very flexible. We don't need to T1, T2, T3. So it's a auto pickup using the margin. So for corporation as well, broker will manage based on dividend, bonus, and right issue. So it's based shareholder instruction only. So our remiser or dealer, we will assist you on behalf. Okay, for the trading limit. For the normal trading limit, let's say you deposit 15K, you only can enjoy and buy the shares using your cash. But for SMF, as I mentioned, 2.8 times leveraging, you can trade up to 140. It's increasing buying power beyond your capital. Okay, and risk and exposure management, leveraging magnifies both profit and losses, requiring careful risk and exposure management. Profit compression example. So profit compression example, for normal yield a profit of 3,250 from buying and selling share with a standard capital investment. So for leverage with SMF, allow worth 99,500. That means it's a double your profit because you are using the margin. You leverage that. So the doubling profit to 6,500 with a same initial capital. For risk of leverage, leverage can be double losses if the market move against the investor. If the price is go up, it's a profit for investor. It's not just a normal. But the very important part, if you are using margin, you need to focus on margin of financing, what we call is MOF. Okay. Definition is MOF, measure the portion of investor position financed through brown funds in a margin account. A higher MOF mean higher leverage and risk. Increase the chance of margin call during price decline. That means, let's say you buy the shares and then the market, the share drop. That means you MOF in the high level. Okay, the broker limits, normally we will give the client is 65% to manage the risk and protect both investor and also firm from excessive the borrowing. So MOF example and impact. So investor deposit a share. This is the scenario how the MOF. Investor deposit the share or investor deposit the money and also shares. Okay, the effect of price drop. A drop in a share price decrease equity causes MOF to raise and increasing risk in the margin account. Importance for investor to monitor is because let's say is sometimes the shares make a correction. That's why you need to very careful using the margin. Okay. For managing the margin, let's say your MOF breach above 65%, as we approve only 65%. So there's a three method for you to regularize the account. The first, additional cash. Investor can reduce risk by injection extra cash into their margin account to increase equity and lower MOF. You need to regularize the MOF below 65%. This will be the 3 days for investor to regularize. Normally, dealer or advisor will inform the client to regularize until 3 days, T1, T2, and 3. Okay. And the second method, you can transfer your shares. Shares that have a value. Okay. And then if you don't want to top up or you don't want to deposit the money, you don't want to transferring shares, you also can selling the shares based on your portfolio. Okay. The best practice for SMF user normally we avoid full trading limits lah. Let's say we give client 10 million trading limit. So you need to focus on, maybe you use below than 10 million. Maybe you can use 8 million first to see how it's work. So focus on the quality stock. Normally, for blue chip stock is the percentage of the margin we give to the client is very high. For the ACE market, we give 60%. Normally, standard 60%. Or for the main market, we give 80%. And then focus risk control strategies. You can diversify, not only focus on the single counter. That's mean you buy, you make the accounts margin constraint. That's not good. Which is you need to diversify your portfolio. You buy share A, share B, and share C, and also with the quality stock. So you also need to regular monitoring the shares because let's say you just let the shares, the interest keep account, and then you need to do your trading strategies, when you need to enter, when you need to sell. Okay. So it's about to end. The conclusion and closing. The capital efficient and leverage share margin help investor to maximize capital efficient and achieve higher potential. And SMF introduced to higher risk and necessitating the disciplined risk management and carefully monitor. Suitability for experienced investor. SMS is the best suit for informed investor who actively monitor their position and understand the market dynamic. Normally, we will suggest SMF to sophisticated investor because they understand the market well. Not only well, it's just discipline, you actively monitor, you can be the better investor. So the powerful investment tools, when used wisely, SMF can significantly enhance investment performance and growth potential. Okay, that's end for me. If let's say you have any question, thank you for your attention. I'm happy to take any question. You can also drop any question to my email and can contact me. So I will pass the floor to the next person.
No. Let me share my screen.
Okay.
Okay. Hi, everyone. Thank you, Yuhana. Thank you, Sinha. I think that's a very comprehensive presentation on both the CFD and the share margin financing. Now that you know how to use the tools to enhance your return, here are some of the stock ideas or strategy that we're going to go for, right? But before I go to, just a quick one. Basically, this is just a disclaimer that this is basically not an investment advisory for you guys. If you wanted to take any, investment position, do talk to your financial advisors, especially in terms of your investment objective as well as your time horizon. Okay. All right, all the data here are sourced from both Bloomberg and our research. So, all right, so today we're going to learn quite a few things. Actually, the deck is quite comprehensive, but I will not be going through everything for time reason, as well as just want to keep things as simple as possible. All right, but we will share the deck to you guys if you wanted to have it. So there are 6 key things that I wanted to share with you, right? Firstly, we want to look at where the geopolitical backdrop is, where we are today, right? We know that we have quite a stressful environment at the end of March, right? As the Middle East conflict escalate, right? Then of course we wanted to look at where the cross-asset markets in terms of how performance-wise, what are they telling us? Whether it's risk on, whether it's risk off, or whatever that we wanted to look into, right? And of course, thirdly, we want to see how the global market performance and its implication on the US market. Fourthly, looking into US sector rotation. Fifth are some of the tactical opportunities and stock ideas, which will be amplified by Viren later on in terms of technicals, as well as some of the recent portfolio positioning. I think this week, one thing we've learned is that it's very important for us to have a good positioning as well as sizing in terms of our position, given the volatility in the market. We've seen a strong bull run at the start of the year. Until now, I think we've seen quite a few set of pullbacks throughout the last few months, and so far market has been quite resilient, right? But before I go into that, just wanted you to look into three big key takeaways from this presentation, right? If there's anything that you will take away from this, I hope you will take away those 3 key things, right? Firstly, the US market has remained resilient despite the geopolitical tension. I'm not sure how many of you remember, but at the start of the year, there have been a lot of talks about sell America and buy into Asia, ASEAN, and the rest, right? But US market have remained strong despite of all the geopolitical tension, driven mainly by the tech leadership, tech AI capex, and a lot of the strong earnings that we've seen in the tech space and the tech ecosystem across the industrials as well. Secondly, cross-asset signals are really telling us that it's still a very selective risk on and not a panic, despite of the sharp decline we've seen at the start of this week. And thirdly, I want you to know that we believe that the technology space, industrial and selected cyclical, still offer a good deal of opportunities. Of course, I think Viren will highlight where to look into on that front later on as well. Okay, let's start and to where we are geopolitically. I think first thing is that we've talked a lot about Middle East tension, increase in oil prices, Fed uncertainty, and risk of concerns. But markets have actually done pretty well up until this week. I think it's most markets are at their all-time high. US are near their all-time high. After the pullback, we've seen quite a fair bit on the front. South Korea before today is also trading near their all-time high. Similarly with Japan market. I think even in Asia, we've seen quite a bit of recovery. So I think China is probably the one that's still lagging quite a fair bit. But in ASEAN, you look at Thai, we've seen a strong rebound this year. Malaysia is probably in the middle ground. Singapore is doing very well. I think Indonesia is the exception of it. Vietnam is also doing quite decent. So in short, markets are pretty much holding up despite of all the fears and all the uncertainties that people have been talking about. Right? I think markets are really differentiating between the headline risk and the lasting damage of it, as well as the opportunities that they are seeing, given the huge spending in the AI and in the tech space in US that spill across various sectors into various markets as well. So volatility wise, we've seen that's pretty much contained. We look at it from the VIX index, and then of course oil has pulled back after the US and Iran peace deal, at least the temporary one. And of course, we've seen tech leadership remain strong, as seen by some of the earnings. I think we will have a lot more signals coming out from the Micron's earnings on Wednesday. Now, why this matters is because in general, usually what we've seen is that in any geopolitical tension, usually when it affects energy prices, you see oil price go up, then inflation expectations would go up, and then your bond yield would go up, cost of borrowing would go up, dollar would go up, and then of course your risk appetite in the equity market would come down. But we have not really seen that this time around, and partly that is really driven by taco, or Trump always chicken up sort of taco trade. Right, we've seen an escalation, we've seen a spike in fear, and then of course we've seen a de-escalation through a lot of various means of communication that the US administration is giving up. And that's when oil prices pull back, inflation fears more or less cool down, and then the risk appetite recover, and then market continue to rally, driven by strong earnings, spurred on by the AI capex that we've seen. Right, so that's basically quite a fair bit of the difference that we are seeing, right? So which is why this time around things really feel a bit more different, because panic did not really fully take over, right? Volatility has stayed relatively contained. US markets have continued to rally, and leadership remain in the growth and AI link areas. Now, this is also validated by the cross-asset market signals that are telling us. In terms, if you look at this slide here, you can see quite a fair bit of things. Right, the stock market have done pretty well. In fact, it's done very well, and up until this day, it's been very bullish. The 10-year yield has been fairly neutral. 2-year yield has actually spiked up recently because of the potential interest rate hike in the second half of the year, and then oil has came down quite a fair bit after the peace deal that we've talked about. Gold has remained neutral after a strong start of the year. So that means that, that sort of fear has really come down quite a fair bit, and dollar has continued to strengthen, and VIX has remained supportive. So what this really tells us is that this is really much a selective risk on, but not without a caution, as seen by this week. You've seen a sharp pullback this week across markets, whether it's US, whether it's South Korea, whether it's Japan, whether it's in ASEAN markets. So when we've seen it across the markets, right? So basically, this is what we are telling you, right? Of course, the headwinds that we want to look into is basically how much the increase in terms of the interest rate is going to look like, whether the curve flattening will be much more than what we expected, and of course, if geopolitical risks continue to reoccur, right? So those are some of the key risks for us to look into. So this is just where the asset class money is flowing. You can look into it later on. And of course, basically, if you look at the message from bond yields, the message from oil, gold, and US, all of that are telling us the same thing. Risk signals are contained, right? Leadership remains in growth and technology, and of course, your macro caution still continue to matters, as seen by the pullback in the market this week. Right. In terms of the next thing we're going to look at is how the global market performance or leadership and its impact on the US markets as well. Right. So if you look at this slide here, you can see that US has done really well. Earnings have done good due to the AI tailwinds as well as the strong economic data. Europe has been fairly constructive, but Japan and Korea have done even better than what the US market is, right? If you've been investing in, I think Viren has talked a fair bit on the South Korea market prior to the start of the year, even. I think that if those who have been following our transporter will probably pick up some of the opportunities there. Of course, there's also a bit of improvement in China in terms of the economic environment, but of course, there's still a lot of caution on the front, and ASEAN has been very much selective, right? As I said earlier, Malaysia is probably in the middle ground. Singapore is doing very well. Indonesia is doing very terrible, and then Thailand is really recovering now. So it's really much very mixed picture for ASEAN market. So what this tells us is really that why is this important is because if you look at it, right, all this continues to trickle to the US market as well. If you look at if you look at this slide, this is basically telling you the US really leadership is focusing on AI, innovation, and your mega cap growth. The S&P 500 is the broad constructive trend that they have. Dow Jones show you the cyclical participation in the growth as well. Nikkei Kospi is really the strong AI link, as well as the strong reforms that they have in the countries. And of course, in China, is the improving but more tactical position. Why is this important is because if you look at this slide here, if you look at the AI leadership, right, the global investment in AI continue to accelerate. So this will continue to support both the US semiconductor names as well as the tech players, those involved in the AI space. North Asia growth will be very important because export growth and capex will continue to support industrial and equipment names across markets, whether it's in US or in Europe. China's stabilization is also very important. That helps to provide the demand visibility, especially for materials, autos, and consumer discretionary, which has probably struggled quite a fair bit so far this year. And of course, the lower oil prices will also help to ease pressure on consumer and support growth stocks. So this is basically why we think it's important, and we think that so far all this environment continue to support that rally or that sort of market growth opportunities for the US space. So there are four key forces. First thing, AI and technology momentum. Secondly, the geopolitical de-escalation. Thirdly, Fed expectation and rate sensitivity. And last but not least, earnings and liquidity backdrop. I think this is very important, especially on the liquidity front. Since the IPO of I think SpaceX, and then of course what we are anticipating the listing of Anthropic and OpenAI as well. So there's a lot of concerns how that will actually affect the liquidity in the market. So far we have seen despite the IPO of SpaceX, things have remained fairly positive. So we do want to pay attention to how that will continue to affect the liquidity as well as the index names. These are just some of the technical and tactical read that you can actually take a look on it later on. All right, so where is the US sector rotating into, or where we are focusing on to, right? So for us, we are really looking into, if you look at here, you can see where it's actually working right now. Tech has been doing very well. Industrial and financials remain very constructive. We are very selective on utilities and consumer discretionary. Healthcare, we are a bit more neutral, but we do think that there's a bit of recovery on the biotech space. I think Viren just wrote something on the technicals for the biotech sector. So there's quite a bit of opportunities on the front. For communication services, it's a bit more mixed. Consumer staples is a bit more weaker, and of course, both energy and real estate is a bit more under pressure. Of course, if there is an escalation in the geopolitical tension again in Middle East, then probably oil sector will benefit from it again. So those are a bit mixed at this front. But what we are seeing is that there's a clear, in terms of leadership zone, right? the AI capex cycle really helps your clouds, your semiconductor, your infrastructure spendings. So your semiconductor demand, you look at all the memory chip players, of course, aside from today's pullback, they've all done pretty well, right? The platform and cloud strength have continued done well in terms of monetization. But if you look at it, the hyperscalers are the one that are probably slower in terms of their share price movement, partly because they are the one that are spending a lot more on this investment. So there's a lot more concern on whether this investment will translate into real earnings or real monetization, right? So these companies are probably the one that are more affected at this juncture. But of course, so far we've seen a lot of earnings revision has continued to support market. So we do think that things remain quite positive for the tech sector. So for industrials, I think they also benefit from that. Your data center build out, your electrical and grid equipment, automation and machineries, all these are also benefited from the AI capex build. I think some of these areas have huge potential. Probably some of the money that is flowing from the big tech names to semiconductors as well as to some of these areas as well. We do think that energy is one areas that are really going to be quite attractive, especially those in the electrical and grid equipment space. Financials, I think this is where it provide you with the stability. Your large cap banks, all this quality, the high rate tailwind that we are looking into. So those things will actually benefit the banks. So we do think that this is very important for you as a core portfolio balance. Utilities and power, very defensive, but there is always that twist in terms of how much more structural tailwind that can benefit from, right? Then of course, what we wanted to avoid from is probably on energy, real estate, consumer staples. So these are some of the 4 areas that we wanted to have a little less exposure as compared to the others. In terms of opportunities on a more tactical front, we do think, like I mentioned earlier, these 4 key areas: tech, industrials, financials, and utilities, right? So these are key areas that we think that there's going to be quite a fair bit of interest. Of course, we are not advocating you guys to buy now. I mean, the market is really very volatile at this point, but I think any pullback will give a good opportunities for investors to start to accumulate. Now, in terms of stock picks, we do have quite a fair bit. So, for example, Micron and Intel have done very, very well this year. I think Intel, Varian has a good call on Intel in terms of transporter, in terms of his technicals. I think he still think that there's a buy call opportunities, probably after some pullback, yeah, given the volatility now. Nvidia and Microsoft have done probably underperformed the rest of the market, but we do think that these two companies provide that sort of AI leadership as well as the ability to monetize from AI, right? And their valuation is probably more attractive than what it was. So these are probably areas that investors can look into to accumulate. So for industrial names, so you have your GV Venoa. So this is mainly on the grid and power infrastructure exposure. Caterpillar, for those who are interested to look into constructions. Eaton is basically for electrical equipment and power management, while Vertiv is mainly for cooling and backup power systems. So if you look at it, a lot of it are quite relatable to some of the AI economy that a lot of the industries are building into. Financials, you have some names here, so you can look at JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America. I think at the end of the day, the idea is really to have these quality anchors in your portfolio to help you to manage that sort of volatility in the market. Now, of course, this is basically just some framework for investors. Now, last but not least, basically looking at your risk and portfolio positioning. I think I've already talked about this. So in terms of the biggest risk to watch out for, I think the renewable oil shock is one area to really look into. How much that will impact the economy as well as inflation is very important. The interest rate increase in US, I think that will also determine in terms of how much more risk appetite investors will have. Stronger US dollar will also be an area to look out for. I think this week we have seen the valuation fatigue in leadership stocks. We've seen quite a fair bit of pullback in the market. So this is some of the key areas that you want to look into. I think earnings is also an area to look out for. I think on Wednesday, after the market closed in US, probably we will have a better picture in terms of how strong the AI growth momentum will be with Micron's latest earnings results. I think that's all from me. So I'm just going to pass the time to Varian.
Right. Thank you very much, Billy. And thank you for coming on to join our webinar. So I'm the last speaker for today. So today I will be more showing you from the chart perspective on the macro side, and then why are we I do agree with Billy that there's a lot of tactical play still in play. I think equities market is still strong in the US, but there's no downside recession yet as of for now, and I'm going to show you why. All right, so based on that, I think because we are doing CFD, it's a CFD team webinar, so I prepared a chart, one glance that you know how is the market is doing. So I did courtesy of reviewing This table actually will be published on every Monday morning. I'm titled under APEC plus US. So these are where I come up with the technical ideas and to tell you guys where the market is heading on, based on the major index that's widely traded around. So for example, we got the dollar index. I think dollar index has already outbeat the equities, given the fact that in recent days, I think 2 days ago, there's a strong breakout above the 100 psychological level for the dollar index for the sixth time. So today it has already trended to 101 within 2 days. So I think momentum for dollar index is likely to be strong, and we have overall score of bullish score of 2.7. So this one really point towards that there's a further upside on this. Now, the next one will be on Nikkei 225, and maybe I'll talk more about the CSI 300, and then followed by the US indexes. All right, for Nikkei 225, I think there's a solid sell down this afternoon after 1 p.m. after 12 p.m. local time. There's a very strong sell off, and this caused by there's a widespread of profit taking, and then there's a amount of like profit taking, risk off sentiment that caused the market to dip down. But overall trend is still up. So we think that there's a possibility that tomorrow there may be some short covering, highlighting maybe a corrective rebound. But we're looking at that. I think we did until the end of June. We are looking at a three-wave correction potentially. All right. So next one, CSI 300. Why do I highlight about this? Because CSI 300 and the Hang Seng Index is actually the total opposite. All right. So CSI 300, Chinese index, but A-shares focus. So it has already break above the 5,000 psychological level. And this proves one thing, that we have already finished the true wave correction over here. All right, so the true wave correction is done. So we are likely to see a further break to the upside to 5,100 going forward in the future. So now the next one, I think I'll talk more on the gold. So for gold, I think is much more like a corrective phase. I think a bearish score of negative 1.3. So gold is the fundamental is that I think the rising 2-year yield actually has caused the shift of funds back into the fixed income, to treasury bonds, etc., etc. So I think gold will likely to decline, and then downside to test the psychological level of 4,000. So if 4,000 break, then we are looking at next support at 3,860. I think there's a very high possibility of it breaking. So I think temporarily we shouldn't look at gold for now to buy or to sell. I think if you buy at this moment, there's no clear signal. If you sell, it's near the bottom, there might be sweet going forward. But because for CFD, you must know that there are some margin to be taken care of, like what Xinghui was saying earlier. All right, so let's go to the US market. So we look at S&P 500 and the NYSE market breadth. It did recover, all right, from low, and then it dipped, and then it point to a slight upside again. But based on this, I think we aren't yet to see any recovery to the upside. All right, this was yesterday on the weekly chart. So I think later on there will be more correction on the downside again. All right, so the advance and decline line, we can see that there is range bound movement. So I think there's to confirm the upside after a sell down that we see in the futures market. I think you want to catch a bottom. I think not yet, but I think that later on the chart, I can point to you some where are the levels to look out for. So for the market breadth itself, you can see that it's range bound. Neutral means that there isn't any new new equities being added into the S&P 500 or S&P 500 equal weight or the NYSE constituents. So it means that there's a chance that market is weak at the moment. At the top, weak, that means that there's a correction that is incoming. But we do not think that there is a recession right now. So next slide, I will show why there isn't recession is because for the 2-year, 10-year yield, we can see that the yield curve is actually not flattened. All right, the yield curve is actually in the bear flattening move. So what does bear flattening move? It doesn't mean that the equities market is going to bear. All right, equity market will crash. No, it doesn't mean that. But it means that the 2-year and 10-year yields are narrow because of the decline of the 2-year and the 10-year. So the spread of the yield are getting narrow. All right, so people are buying and then cause the rates to actually tighten up between both the 10-year and 2-year. So there is some sort of like a downward curve. Is a bear flattening. It means that there's a narrow trend. So if you look at that, yield curve actually spike and then it followed by a correction. So this happened in 2022. All right. So when this happened in 2022, there is a strong and there's a sorry, give me a moment. There's a strong correction of negative 27% for the last 3 quarters of 2022. Then so after that, it recovered after inversion happens. So same thing happened in 05. Yield curve steepens, and then you get your Lehman Brothers crash, we call it 57. Dot-com bubble 48%. We do have some yield curve heightened, then because the spread in the 1990s, there's some sort of correction, which is quite similar to what we happened here in 2022. No major recession, but there's a closure. And then this one is I think the mid 1990s. I think that is happening during the Asian financial crisis. All right. Okay. So I will go back to the market breadth. So for market breadth, I think you can look at the percentage of ratio of stocks above the 200-day moving average and 50-day MA. So we can see that the ratio is flat at the moment. After that, this is a market breadth model that my colleague Jake developed. So we can see that it's flat, so likely to see on the downside. But I think good news is, I think what we are going to see on the S&P 500 is once the peak, the put call ratio actually peaks to around 1.43, and that's a level that we watch for a tweak to a downside again, because every time it peaks, actually it has a potential of extreme contrarian conditions. So that means that maybe the market is likely to rebound further onto the upside again. So this, but this one is on a range bound. That's why we failed to clear a new high, so we came down. But we can see that the heightened or ratio over here has already declined, but it's a peak at the moment above 1.2. So this shows that the bottom is in already here after that. All right, so complacency, rise up, and then peak, came down, and then after that, market rebounded again. But this time around, the S&P 500 failed to clear above the key resistance at 7,560. So this may signal more correction down. So we are looking at 7,100 level or 7,000 psychological level as a rebound zone going forward. All right, so and now back to the yield curve analysis. Excuse me, and the treasury yields. So one metrics other than the 2-year 10-year spread, we look at the junk bond yield. So what is the junk bond yield? So it's like your BBB negative, or your C, your double C, that kind of like your Venezuela kind of bond. But this time around is corporate bonds that normally is B minus, BBB or double B minus. So these are the bonds that provide higher yield. So currently the yields are spread very, very low. So we think that there's a correction. We think that as long as it don't spike above 3 or the new high, I think we are safe from a recessionary risk. We can see that this was in 2022. All right, and then after that is face a correction over here. All right. All right, fire forward inflation. So overall, in the long term, all right, fire forward has been range bound within this. Means that current situation is the Fed think that, oh, inflation is high. I think we should be on the we should on the watch out. Fed may raise rate, but given the fire forward inflation rate, this is tracked by the St. Louis Fed. It has been flat, declining at a certain time. So if you do a correlation, chart to a chart, you can see that once it's flat, I think equities market tends to be on the rise on this. So not much of a major correction except for this, and maybe in 2022. Right? All right, so lastly, we chart the valuation. So as a chartist, not only we look at candlestick, but we look at the valuation of the S&P 500. So for S&P 500, I think we're going to look at the P ratio. So the P ratio is at third standard deviation, but given the fact that the rising EPS from continuation operation and the price to book, we think that there's one more move to the upside. I think maybe beyond the third standard deviation. So we are not yet to near to the top. And if we look at the Bloomberg consensus, all right, I think it's near to the second only. So we still have a lot of room. So after a correction finish, I think there's more room for rebound to the upside. That's just like what Billy said. But I think Billy go through more in details in what sector to look in for, and this can be found in our reports, and of course my daily transporter pick as well. So right now, we think that in the summary, I think market breadth recovered, but still in a very light bullish scenario. Overbought momentum has been confirmed, and then put call ratio dips. And then we see SPX likely to correct. Yield curve, this is the most important. I think we are likely to see a flattening phase. So we are again chasing a high. We do see a rebound in gold previously, but I think this one maybe need to change. Larger degree correction is happening in September, not this month. All right. So as S&P 500 has failed to clear this, and then we have dipped below 7,004 based on the futures. So we might see a third wave correction down to 700. All right, so I think that's all for my sharing. I shall see, is there any Q&A for us or me and Billy or not? If I'm, okay, there's a
question.
asking. Yeah.
Brian, there's a question on I think you can answer that one. I think it's fine.
Yeah, I'm slightly bullish on the US market, but still concerned about certainty. I would suggest to balance exposure. Should I long go? Like I say, not really at the moment to long go on this. So, but I think right now is either you can, I think it's too late to short, or you can wait for a corrective rebound to short using CFD, or you can just wait until the key levels that you're comfortable with, then you go into the sector to the index. If you are looking for equities, like maybe like what Billy has shared earlier on, I think the technology is still the key winner for now. All right, the next one is financial, but financial, you look at JPM, Goldman Sachs, they have a trended high, so wait for a pullback and then go in again. If you really want to go in, I think healthcare, biotech companies that are bottoming out, like your Moderna, I think you could look for a good level that you think comfortable in, and then you can buy in going forward. All right, so I hope that answered your question on this.
Maybe just to add a bit on that, I think it's also about your size position. I think that's very important. Like if you've been going all in to the market directly straight away, I think it's probably a bit hard for you to re-strategize in the event of a pullback like the one that we are seeing this week, right? So I think position sizing is quite important. So it's very important for you to know when to leverage on your CFD tools, right? In a positive bull market environment where there's a clearer trend, and that's probably when you want to utilize that. Like in a more volatile and fluctuating environment, probably you want to wait a bit more on the better entry level to use that. There's a question on the AI boom. When it is over, what is the next likely industry that is likely to run and why so? So I think the AI story is not a 1 year story. I think this is a structural multi-year investment story that we are looking into. So I think for the next 1 to 2 years, we probably see a lot more benefit surely coming from those who are in the semiconductor space, in the chips, memories, even your power and some of those, right? So that we've done a report on the AI stack ecosystem. So that's probably some of the areas in the next 1 to 2 years. But I think it's also very important for the hyperscalers, for those who are investing in all these AI technologies, to be able to monetize it, right? So far, I think the base case is that they will be able to monetize it. We've seen they are also tapping onto the bond markets. I think if you look at the yield that they are getting, is actually quite attractive. So they are basically able to borrow at a fairly attractive level, which means that markets are also a bit more positive in their business prospects and everything. But they still have to prove it, right? So we have not really seen it. We've seen growth. So for example, you look at Microsoft, you look at Azure, you can see the growth is there, but it's probably not as high as what you're seeing in your Nvidia, in your Micron, because they are benefiting from the adoption of the AI usage, and the adoption is not as fast as this capital spending that they're investing into. So these hyperscalers are really spending a lot of money to build that up, right? So if you look at SpaceX, for example, they talk about wanting to build data centers in the space and things like that. So whether that materializes or not is another thing, right? So after the next 2 years, so we probably need to see whether the hyperscalers can benefit from it. So if the hyperscalers can do, and we do think on a base case scenario that we will see a lot more adoption on AI, so then this will be the next space to look into, as well as the software players as well, whether your software are able to leverage on that to see a lot more earnings coming from that. And then beyond that, then the next probably 5 to 10 years, we're probably looking into more robotics rather than just the software players, right? So that's really basically the trajectory of the AI structural growth story. So of course, along the line, it's not everything AI. I think there's also things like your industrials, those who are supporting the infrastructure of the entire AI ecosystem, as well as how businesses that tap onto this AI technology to build up certain business mode. So for example, we are seeing some of the software players like Salesforce, they're also facing new competition that are coming out from this. So of course, a lot of these are still very new. So we are not very certain how this will translate into yet, but pay attention to how some of this will affect, industries like your banking sectors, like your conventional sectors, like your consumer, how they're going to leverage on all these tools to really gain that scalability. So that's where we want to see, right? So I hope that answered the questions. I think that's all. Sina, is there any other question?
I'm so from Facebook, there's one participant asking, can buy VOO?
I think from a technical perspective, it's easier to give that rather than.
You
want
can
to show
buy
the
as well
chart?
as I mean you VOO, I think one of the largest. I think it being overtook already. But anyway, it's still a very good investment to have. I always make you can buy if you got money. All right. I think this one my friend also always tell me that you got money, you can buy. Joke aside, all right. I don't think there is I don't think this is a good level to buy now. Okay, so I think let me just show you, since with that, I think I just show you my chart on the wait, let me just give me a moment. I think if you can look at my screen over here, I think if you look at the SPX, okay, I think VO, let's look at VO. This is still the same thing.
It's the same thing.
Yeah, so if you look at that, I think from the technical perspective, my indicators are looking at not very pleasant looking for now. We got a short-term declining momentum divergence, and there we can see that the overbought crossover has started to take shape. So once it dropped below, means that there might be a correction. So if you look at that, I think pre-market, this is affected by the future. So maybe some rebound after that, but definitely it go down. And there's this chart pattern that I'm always very wary. It's called a diamond top. All right. So what is a diamond top? Is basically it's like a head and shoulder, but it's a more complex head and shoulder because of this. There's a breakdown and then up and then feel to clear a high, and then there's one more onto the downside again. So My question is, I think I'm looking for maybe further downside. So if you want to look at that, Fibonacci, I think 658, and then maybe 645. If the correction down will be a good level to buy. So I think then the next question, then is that a recession? No, I don't think so. Because if we decline, I think it's only 7% decline and then 2%. So if we translate to the SPX, so remember the recessionary, the clue for recession is S&P 500 drop below 20%. So if we go all the way down to 7%, it's only a 7% drop from the top, right? So unless it goes all the way to fill up gap, which likely possible, still only a 12% drop to the downside. I think that this one will be fulfilled maybe in September or October, but I may be wrong. So yeah. All right. So I hope that answers your question on whether should you buy. I think we just stay put and then just wait for a while. Hold cash, yeah, because dollar index is on the upside. So just hold cash. So I hope that answers your question.
Cash in dollar lah, not.
Yes, yes. Sorry.
Yeah, I think
What's your?
So I
Oh,
think
there's
there's a
still more.
question on
More question.
Alibaba and United Healthcare. So I think for Alibaba, it has dropped quite a fair bit on a year-to-date basis. I think it dropped about close to 30%. I think about 30%. And from a valuation perspective, it is interesting. But I think the Hong Kong market is been under pressure for the longest time. I think at the end of last year, we've seen quite a bit of recovery, but I think it's probably too early to jump into it. So if you ask me, I think better to just stay away from the Hong Kong market for a fair bit now, given the uncertainty. But of course, if you think that you are holding it for the longer term, then I think it's probably a good entry level that you can look into. But if you are looking at CFD to buy into all this, then maybe not, because I think that's probably a bit more risky on that front. For United Healthcare, I think valuation wise is probably already there. So it really depends if there's any other new catalyst that's coming out from there. Viren, you have anything on Oracle and Adobe?
I did share before on Oracle. I think I wrote on something on Transporter, but I think it went up and then hit my first target price or something. Then after that, the rest is then it just pancake lah. So there's a Malay word for yeah. So it went up. So I think I did it in April or something or May. Then after that it went up. Then after that it came down already. So this one just start sell off with overbought crossover being confirmed. Everything. So I think it might just go lower, maybe test this level at 141.72 on this. Oracle and which one, Bin?
And Adobe.
ABB. Oh, Adobe is.
Adobe.
Yeah, Adobe, no chance at all. I mean, you can look at all the way down. No bullish reversal or anything. No strong pump up with volume. You can see that the volume over here is on the 12th of June, but the spread of the candle is so small that is negligible. So means that there isn't any activity. So the only activity I can think of is people maybe short covering, right? That caused the huge share price to actually jump, right? But you ask me to buy, as a trend follower, no, I won't look at it. I think that is the best case scenario for Adobe is likely to be consolidating. If you really want to know, then I think you have to look at the valuation, the fundamentals, whether is this a world story or not. So remember that I always have this guy telling us that technicals only tell you where the price is, how to help you better fund the entry. But the one that really moves the market is really the fundamentals. All right.
Let me just add a bit on that front. I think from a fundamental perspective, there's a lot of concern in terms of how Adobe, whether the all these AI tools that can generate visual images and all that, whether that will sort of replace some of these Adobe tools in terms of the utility of it. And of course, Adobe, they also have their own AI solutions, but I think is in terms of adoption is probably much slower. So there's a lot of concern on the front. From a PE perspective, it's really trading at a fairly attractive level, about 11 plus times. I think industry is probably around 20 over times. So that's, I guess it's a question of whether if you look at their earnings, you can actually go through some of the earnings transcript and see whether there's a lot more positivity on the adoption of the AI. So at this juncture, at this moment, we are not seeing that. So unfortunately, that's why the market is probably reacting to the news flow on that front. On Ping An and New World Development, do you have any?
I have on Ping An right now. Hong Kong really not doing well. I think on the Hang Seng Index is down. But there's only a few selected stocks that's running very well. But on Ping An downtrend, I will look for further correction down to $47.80. And maybe on to $44.02 because of the very structure. So if you look at the whole structure, really broke out of the uptrend channel already. So not a very good buy for now. So I will just stay away from now. New World Development, I think is same thing. I did have a transport pick on here, and then I did a buy over here, but unfortunately got stopped out with a very tight stop loss because once I issue an idea at the top, I will tend to have a very close stop loss level. So 1, 2, 3, 4, 5, 3-wave move. I think likely to go down lower to $6.62 or $6.05 on this. All right. Citrum neutral. I think yeah. So Citrum, I think is a neutral move. I think it's a breakdown. Rebound at $2 is kind of weak, and 1.94 is kind of weak. So I think there will be one more round of correction down to 1.86 or 1.87. All right.
I think. Do we still want to?
Okay. Maybe one last one. I'll do Maxis. In the interest of time. Maxis Berhad. Okay. So Maxis downside. We can see that it went down. So I think our Malaysia technical analyst, I think Sesiang was mentioning about finance. So perhaps you can look at the finance, but for Maxis, nope, not yet. Range bound for very long. No clear uptrend. And then you look at the internal uptrend strength structure, you can see lower high, lower low, lower high. Strong sell down. So wait for oversold to be confirmed. Then we'll see. But for now, no. Maxis not much. All right. Okay.
Okay. All right. I think that's it for today. Isn't it? Correct.
Okay. So thank you both for the sharing, and then thanks also our audience for joining us today.
Yeah. If they need the slide or the deck, just get it from us. Then you just send it.
Okay, I provide you the email.
Yeah. Okay. Thank you.
Okay, thank you all.
Thank you. Bye. Good night.
Good night. Bye.